Welcome back to All Things Money. I'm your host, David Blain. And once again, if you have any questions or comments on our show, feel free to give us a call at 633-0107 during normal business hours. Our email is allthingsmoney@dlblain.com. And we certainly welcome your comments or questions. During this segment, we're going to talk a little bit about the stock market and what's been happening. We talked a little bit earlier about our expectations for the market in the year 2010. So far, things have borne out to be true. There's been an increased volatility. We've already seen a correction of about 8%, and the markets the past couple of weeks seem to have been recovering from that. I expect the whole year of 2010 to be somewhat similar in that there'll be increased volatility. There will be some periodic declines in the market. At some point, we may even see a double-digit decline, but currently we're maintaining our overweight stock position. There's a couple reasons for this. Number one, the overall economic and monetary situation remains favorable. Interest rates are still very low, which tends to correlate well with stock. The recent weakness has cleared out some of the excess optimism. As you recall, I'm big on looking at investor sentiment and optimism and pessimism. And in the middle of January, things were overly optimistic, and the market was ripe for a correction, which did indeed happen subsequently. And the third thing is that the majority of markets around the world are still maintaining their upward trend. And that's something that's important, is that you have all the economics and the unemployment data and all these different figures. What people sometimes forget to look at is actually what is actually happening. And what is actually happening currently is that the majority of markets are still in nice upward trends. A couple of things that we look for. I get this question all the time. Well, what would cause you to go underweight equities? And so the first thing, as we just mentioned, was we look at the actual direction of industries within the market. And so we look at a composite. If the majority of industries are still in an upward trend, actually it's not really a majority. It's somewhere when we see numbers in the 50-60% range, we start to get a little bit nervous. But historically, the median low has been about 46% of industries in an upward trend, meaning that if only 46% of the industries in the stock market are in an upward trend, that usually signals the low. The peak is usually somewhere around 80%, which we have achieved very recently. And so we're watching to see when industries start to fade away. The other thing that we look at that both in the U.S. as well as we look at the percentage of global markets that are continuing in an upward trend. We follow about 42 markets around the world, and when the majority of those are still in uptrends, we feel positive about the market. As some of them start to head the other direction, we may reduce our exposure to equities. Some other things that we look at are new highs versus new lows. This is a great indicator to see. We like the New York Stock Exchange indicator, and you look at the number of companies, the ratio of companies that have reached new all-time highs versus those that have reached all-time lows. And once again, these numbers are not consistent with a market that is ready to enter a prolonged decline. Some of the other things that we look at around the world, with the resumption of this bull market, the emerging markets have once again resumed their upward march. And we'll look at a few of those things. Kind of interesting, you hear in the United States a lot about this lost decade, the past 10 years, where the S&P 500 hasn't returned hardly anything. Well, that has not been the case around the world. A few selected markets, for example, the Brazil, since 1999, the average annual return has been 22.7%. Certainly not a lost decade by any stretch of the imagination. Mexico at 21.1%. Indonesia at about 18%. Venezuela at about 25%. In fact, if you average together Latin America, the average since 1999 return for Latin American stock markets has been 22.2%. It's been the fastest growing region in the world for the past 10 years. A lot of that is due to a lot of the natural resources in Brazil, Venezuela, Mexico, of course the oil. Brazil is the number one or number two exporter of tons and tons of raw materials and foodstuffs. It's really an amazing country if you study it. We see that the second fastest growing region has been emerging Europe. Some of the countries that stand out in emerging Europe, emerging Asia has been the third fastest growing region. We see developed Asia coming in at about a 4.6% rate of return, and developed Europe at 0.7% return over the past 10 years. Once again, comparable to the United States, which has been flat to negative. And so we see that all the growth in the world, at least in the stock market, has been in the emerging economy. So we'd encourage you, when you're looking at your portfolios, don't get locked into the U.S.-centric view of the top blue chip companies. It's simply not where the growth is going to be. Notwithstanding some of those companies that have exposure to these overseas markets that are growing fast. Some of our big multinational companies, Coke, Coca-Cola, the majority of their profits are derived from overseas. But we would encourage you to take a look at, through maybe exchange-traded funds, investing directly in some of these regions of the world, some of these stock markets, and take a look at them because they certainly, at this point, there's no reason not to believe that they won't continue to lead as the world economy recovers. That's exactly what's happening currently. So we're going to take another break now. Once again, for All Things Money, my name is David Blain, and when we come back, we'll answer some of our viewers' mail.